and for his views on where on earth we are going with monetary policy in these skittish global markets, who better than former Reserve Bank board member Professor Warwick McKibbin from the ANU Crawford School of Public Policy.
There are three wars going on at the moment. There's a trade war, there's a currency war, and there's a Twitter war. And all of them are interacting. And what I mean by that is uncertainty is rising sharply. The policies of the major economies are actually focusing on the wrong problems. The trend declines we're seeing in growth are driven by real problems, but the central banks are being asked to pick up the pieces, and they just cannot offset these long-term trends with short-term monetary instruments. And eventually markets have to realise that their asset pricing that's in the market is actually not the right price of these assets, and we're facing a very dangerous situation.
In the United States in particular, we've got Donald Trump putting a lot of pressure on Jay Powell there. He's saying, you know, the answer is the problem is not China, the problem is these interest rates.
Well, the problem in the US is that there is a decline in productivity growth and demographic growth. That's global. So the global economy has been slowing on a trend, and he's imposed this very large tax cut, which was supposed to increase production in the US economy, but it was really a wealth transfer to the rich. Investment is sluggish not just in the US but around the world, and investment is sluggish because the US government is building a mountain of debt, as are many other countries. People don't know who's going to be having to pay those future taxes, but someone will. And so why would you undertake long-term investment in any economy in the world at the moment when you have such uncertain times and you have such strange policies coming out of the White House by Twitter? So I think the undermining of investment through political uncertainty is the key driver, overlaying all of these other trend problems we have in the global economy at the moment.
Back in Australia on Friday, Governor Philip Lowe was grilled at Senate estimates. I mean, he's obviously very focused on the trade war, presumably because of our direct relationship with China there.
Oh, it's not just the trade war that's a problem for Australia. It's just the uncertainty is reducing global trade. If you have a real trade war which spreads beyond China and the US, that's a big negative for the global economy. Nothing we can do in Australia, in my view, can offset the negative impacts of the trade war. This is very different to a cyclical downturn or a financial crisis like we saw in 2009. If you look at where global growth came from over the last 30 years, it came from trade, openness, and central banks don't have that degree of capacity to generate the offsetting growth that's needed. So you have to avoid a trade war at all costs. If it occurs, Australia is in a better position than most, but we're not going to be able to avoid the consequences. And having interest rates at ultra-low levels really puts us in a position of one hand behind our back.
Yeah, so what do you think of our own monetary policy stance at the moment? Because certainly Tim Wilson was questioning the governor on Friday about the value of these last two rate cuts, and particularly the impact on depositors.
So I think there's two key problems. One is you really have to explain, and I don't think the bank has done this adequately, you have to explain why you think cutting interest rates down to 1% will actually stimulate the economy. Now, one of the arguments the bank has made is that it will cause a depreciation of the Australian dollar, but we're in a world of currency wars, and so that mechanism will be easily cut off by other countries following ultra-loose monetary policy. So then the question is, what are the other channels? And I just don't see the positives coming from lower interest rates for consumers or lower interest rates for firms undertaking investment is enough to offset the uncertainty that's generated by ultra-low interest rates. And so I think the problem is you cut rates too much and people lose confidence that the central bank actually knows what it's doing. And this is a global phenomenon, but it just doesn't mean it's right to do it in Australia if they're doing it everywhere else.
All right, what about the extra cash to households that it brings? Because that was another thing mentioned, I think.
Well, there's two sides of this. If you're a borrower, then you get extra cash because you don't have to repay as much. But if you're a lender, if you're a retiree, your income will go down, and you have to find other sources of investment, more risky activities to invest in to sustain your income levels. And so there's two offsetting effects here. Now, in normal times, the borrower effect tends to dominate the lender effect, but in these times, I would suggest that that monetary channel really isn't what's going to stimulate the economy, and it hasn't done it in other countries. Why do we think it would do it in Australia?
So, Warwick, what do you make of the decision that has been made this past week by the Governor of the Reserve Bank of New Zealand, you know, a 0.5% cut there, and, you know, talking openly about the concept of negative interest rates?
Again, I think the New Zealand Central Bank is also talking to all the other central banks in the world. There are two views out there across the central banks. One is that the future looks quite bleak because there is a global recession coming. The bond markets are pricing it in. The rhetoric in the US is getting worse in terms of trade, currency wars, a president that's making policy on the run by Twitter. So if you think the global economy is going into a steep downturn, then that's one reason to cut rates. The other reason to cut rates would be that you just think, well, everyone else in the world is cutting interest rates. If we don't cut our interest rates, our exchange rate will appreciate and we'll end up getting a negative shock. So let's just follow all the central banks. Let's push up against the unemployment rate, because the idea now is that unemployment rates that start to cause inflation are much lower than we expected, and that there's a lot more capacity in the economy, so let's just push the economy right to the limit until we see inflation. Those two views are both consistent with what central banks are doing, and I think that's a very dangerous situation because everybody is following each other down on interest rates when the key problem is economic growth, and the key drivers of economic growth, productivity, investment, human capital, that's where the solutions lie, not in monetary policy trying to offset significant real declines in economic opportunity.
One of the things that I was interested in was Philip Lowe saying that actually the bank had not been able to predict the level of employment. You know, employment to population is actually at a record high, but they couldn't predict this extraordinarily high participation rate and how fast it moved.
That's true, and that's also a phenomenon in many countries. The key issue here, though, is monetary policy the right way to deal with these big shifts in economic trends? The big shifts I'm talking about is we have an energy policy in this country which is causing extremely high energy costs. That means lower economic activity, uncertainty for businesses to where to invest. So the investment in Australia is weak, not just because of global phenomena, but because our local economy needs to have clarity on some key issues such as energy policy, climate policy, even on the tax reform. We need more than just lower taxes. We need better applied taxes.
Would you put energy front?
Clarity.
Yeah, would you put energy reform as front and centre, though, in terms of the to-do list?
I would, because I think what we need here is an increase in private investment. If you get investment flowing in the economy, that increases economic growth, that increases wages, that increases spending in the economy. So stimulating the economy through production rather than through just artificially making money cheap is really the answer. And energy policy is a key part of that. You're getting whole industries that are coming under stress because they don't know what the price of energy will be. The gas policy, the electricity generation, distribution policy, it needs to be clarified and it needs to have a longer run perspective. Once private investment starts to take off, then that starts pushing the economy to a higher growth path. The Reserve Bank can't achieve that by cutting interest rates to zero.
Warwick, how serious is the situation that we here and around the world we've got ourselves into?
I think we're in a very dangerous position right now. We've had a whole decade since the financial crisis where we haven't addressed all the key problems in the global economy, and we've got a trend, as I mentioned, a trend decline in all the drivers of economic growth. And then we have the central bankers are all going to the same meetings, talking about the same problems and following now the same policy prescriptions, and that policy prescription is ever lower interest rates. That does not solve the problems, and that creates an incredible distortion in financial markets, the valuation of assets. It changes people's incentives to undertake risks. It creates all sorts of financial creations of apparently low risk assets like we saw during the financial crisis last time. We're just distorting the system so badly when the fundamental drivers of growth need to be addressed, and the incompetence of the President of the United States in damaging the global trading system needs to be dealt with head on, and that's a turning point, in my view, over the next few months.